सर लाइव होए गए अभी स्टार्ट करो लाइव होने पर
ठीक है जी। Good afternoon, everybody. Okay, so I am assuming that you can hear me, you can see me, and you can see a screen. In case you are, I would request you to just give me a thumbs up using the chat window or the Q&A window. If you can see the chat window, please confirm that you are able to hear me, see me. Okay, let me see. Okay, I can see some participants here. Okay, I'm not sure if my voice is audible to you or how many participants are there. All right, so now it is confirmed that you are able to see me, hear me, right? Thank you so much for coming here, and once again, my sincere apologies for the extensive delay. I mean, this is too much of a delay, where a session is supposed to start at 3, but we are starting at about 3:40. That's because of a lot of technical glitch that we came across, and sincere apologies for the delay. So basically, what we're going to do is we will talk about the new business valuation session or the module that you have, which is paper 20A. My name is Vikash and I am a professional valuer, also have been associated with the institute since some time now. So I'm going to talk about what this paper is all about, what to expect, how to prepare for this paper, and some basic insights that you might need that might be helpful for you for the examination. So if you look at the structure of this, right, of course, this is 50 marks, right, and then probably I mean, this is just 50 marks, and the first part is strategic performance management. The second part is business valuation. I understand you already have a paper called business valuation in your old syllabus as well, but there are some changes, there are some revamping that has been done in the new version of your new syllabus. Now, for those of you who may not be aware, valuation is considered to be a sunrise profession right now. I mean, there's a lot of regulatory improvements that has happened in the valuation space. Companies Act now recognizes business valuers, which was not there earlier. So it is a full-fledged career opportunity. There are multiple regulations under which evaluation is required to be done. For example, there's a concept of a registered valuer, which, like I said, has been recognized under the Companies Act, Section 247. So any major transaction that a company enters into, for example, the company goes in for, so let's say a startup tries to raise funds, right? So it has to issue the securities against raising funds. So then a valuation a report is required from a registered valuer. If a company goes in for a merger or an acquisition, again, you need to either identify the value of the company that you are acquiring, or if there is a transaction that's happening against exchange of shares. Once again, you need to value both the businesses, identify the value per share, and then a share exchange ratio is required to be assessed. Again, that's primarily done by a registered valuer. In case you're not a valuer, you become or you join a merchant banker. Again, so any work that a registered valuer does in case of merger, right, of a listed company, then there is a fairness opinion that is required to be given by a merchant banker, which is again an application of business valuation. Whenever a company issues any ESOPs, a valuation report is required. If there are transfer of shares, valuation is required under the income tax regulations, right? So if there is any intangible, so even after the merger has happened, right, there is a concept called purchase price allocation under Ind AS. You would have heard about it in Ind AS 103 under business combination. So purchase price allocation also requires a valuation from a registered value. So there are multiple areas in which a valuation report is required today, and it's a very, very interesting profession, right? Now, what does your syllabus have, right? And what is covered in your new syllabus? So like you have the new book. In the new book, your valuation is covered under paper 20A, section B. So what do we have in this, right? Let me just quickly walk through the book and tell you what do you expect in each of those chapters, right? So the first one is talking about the fundamentals of business valuation, where we talk about what's the purpose. I've just discussed some of the purposes. Then we talk about valuation premise, approaches, fundamentals of valuation, which is risk and return. You learn a little bit about financial statement analysis, which is fairly easy. You've already done that in many cases. And then we talk about what is market value and enterprise value, right? That's what you have in the module 5. So basically, if you look at it, right, what are so the key terms that hovers around valuation includes market value, liquidation value, investment value, fair market value, and equitable value. So there are different nomenclatures of value which is given in different regulations. That's briefly covered here. Mostly we deal with something called fair value. That's what your basic application of value would be. But for example, if there's an insolvency happening, which is also covered under the Companies Act, you might also need to calculate the liquidation value. If you're doing valuation for financial reporting purposes, for example, a listed company reporting its financial statements, reporting some of its financial assets at values. So then we talk about the investment value. Sometimes we also refer to fair market value as fair value, right? So I just discussed different areas where valuation is required. Now, when we talk about valuation premise, very quick, very small, you can get theory questions on this. So there are 5 premises of value. These include highest and best use, current use, orderly liquidation, forced sale, and going concern. So as you can imagine, if you start from the bottom, going concern, when you're valuing businesses, you would value it based on going concern. Forced sale and orderly liquidations are 2 premises which are used in case of liquidation. So if a company is not expected to continue in the long run, it would have liquidation or a forced sale. Again, depends on marketability. If you have time and you're going to sell it off, it's orderly liquidation. If you have to sell it overnight, it's forced sale. Then you have highest and best use in current or existing use, typically used for physical assets, right? Like a land and building or a plant and machinery. So what is the context? What's the premise under which the valuation is done is what is covered here. Then this is a very important part of the entire syllabus, because the entire valuation theory or the entire valuation application hovers around this part, which where we talk about the three broad approaches to valuation. We talk about the market approach, the income approach, and the cost approach. So here, this part is going to be mostly theoretical. You need to understand what are the three approaches and what are the methods under the three approaches, and when do you apply which approach, right? So market approach, usually we talk about relatives and comparable situations or listed companies. So if you have to apply the valuation of a company like Reliance Industries, you would simply say, hey, what's the market value of Reliance Industries? We look at the price multiplied by the shares. That's valuation of Reliance Industries. If it's a private company which is very similar to a listed organization, you can apply multiples or transactions. So that's where market approach is applicable. And this section also talks about when do you apply market approach, like I said. Then you have the different methods under market approach. So like I said, you can use market price, comparable companies, comparable transactions, and so on. Then you move to the income approach. Now this is where you would use the discounted cash flow if you've heard about it, right? Or you apply the net present value techniques or the free cash flow techniques and all of that. So income approach is the most fundamental part of valuation, which says that value of an asset is the present value of the cash flows associated with that asset. You know the definition of any value of an asset, right? So here is where you would apply the discounted cash flow. So once again, you will have to look at when do you apply income approach, what are the conditions, and then how do you apply it, what are the methods around it. So in this chapter, we have briefly talked about what are some of these terminologies. We've talked about what is a discount rate, what is accounting profit, what is cash flow, what is DCF, right? All of those basic concepts are introduced here. And then there's another version of it, which is called capitalization of earnings method, where if you don't have the cash flows, you can look at the profit and loss statement and identify the value of the asset. Next, you move into the cost approach, where again, we say that, hey, if the business is not expected to go on in future, or if it was just born yesterday, what method, how would you value that asset? So if the business is is very early or is nearing its grave, then you apply the cost approach, right? Which is basically nothing but the balance sheet value of the company, right? So you look at the balance sheet, you say, I don't care about the future, I don't care about the past, I see what is the position of the business today. You would look at the cost approach based on the balance sheet. If you're valuing any tangible assets, etc., then you look at the replacement cost or the reproduction cost method as well. Okay, I'm going to quickly keep revisiting the chat window. If you have any questions or if you want to raise hands, you can use the Q&A window or you can use the chat window to let me know. Okay. Yeah. Can you just confirm if you're able to hear me, if everything's going okay? Are you there? No response.
Yes, sir.
Yes,
Everything
okay.
is over,
You are able to hear me, right? Okay,
sir. Yes,
thank
sir.
you.
Yes,
Thank you very much. Okay, so moving on, then we talk about risk and return. Now this is going to be a revisit of the risk and return that you might have done in your other modules as well. You might have done it in your strategic financial management or even intermediate for that matter. So we are reintroducing the concept of what is return, what is risk, what is standard deviation, right? What are the different types of risk? Now, some additional areas that are covered here is something called beta, right? So for example, when you apply the discount rate, so for example, in your strategic financial management, you might have understood about what is net present value or what is capital budgeting. There, you in most cases, the discount rate was probably given to you. Now here, you would need to assess the discount rate, right? Now, what is the discount rate? It could be the cost of capital. It could be the expected rate of return. It could be the required rate of return on equity, or the cost of debt, or the weighted average cost of capital, etc. So here we revisit the concept of risk and return, but we contextualize it in the context of valuation, right? Or a company value. So here you will learn about two additional terms, systematic and unsystematic risk. Systematic risk, the formula is given, systematic risk is total risk minus the systematic risk. And then we introduce the concept of beta. Now, let me tell you, friends, it is very, very important to have a good understanding of this. We have not deep dived into it, but you need to have a very, very good understanding of beta. What is it? What does it represent? How is it calculated? Right? What is the impact? What can be the variations of it? Everything should be very, very clear. This is one area which is important from an examination standpoint. It is important from an interview standpoint. It is important from a practice standpoint as well, right? So we talk about that here. Then we move into financial statement analysis. There's no point in talking much about that here, right? You have very basic, but still very important financial statement analysis. Remember that here, when you are doing the analysis, you can't just do the analysis and leave it there. Again, you have to remember that we are doing business valuation here. So whatever analysis you are doing, you also need to be able to assess the impact of this on the value of the business, right? So if the margins are going high, what is going to be the impact on the business? If the margin is lower, what is going to be the impact on business? If the current ratio is very high or very low, what will be the impact on free cash flow? What will be the impact on business? All of those things should be very, very clear to you, right? What is the application of interest coverage ratio? We know that interest coverage ratio tells you that how many times the company is earning profit so as to be able to repay its interest or pay its interest. But how is it relevant to anybody who's not a banker, right? So your interest coverage ratio is applicable or it is relevant for calculating the leverage portion, right? It is helpful in calculating or assessing the credit risk of the company, and that further has impact on calculating the cost of debt. So those aspects should be clear to you, right, when you are studying this part of the module. Then here we go about talking more on the valuation ratios as well, right? So for example, what is a PE ratio? What is a price to book value ratio? What is price to sales ratio? All of these ratios are important to be understood because you would be applying these ratios in valuation of the companies, and it is not going to be very simple security analysis kind of valuation. It is going to be fairly comprehensive, right? So you should be clear about it. Then, for example, you're talking about inventory turnover, creditors turnover, debtors turnover ratios. Once again, you've read about this maybe in your intermediate or even in your undergraduation program, but now you need to be able to understand the application of it. Why are we learning about this, right? So when you do financial modeling, you know that, let's say, the creditors turnover ratio today for a company is, let's say, 50 days, right? So if you're doing the financial forecasting, and you assume that the company is going to continue to have a creditors turnover ratio of 50 days, considering a cost of sales, can you calculate the value of creditors, right? So these ratios will help you assess or these ratios will help you calculate the forecasted financial statements of the company. So you need to be able to understand that very well. Okay. Same will happen for fixed asset turnover, same will happen for debtors turnover, same will happen for inventory turnovers, and so on. Next, you move into capital structure analysis. You will also have to learn about the debt ratio, the debt equity ratio, and so on, because again, these will be helpful in calculating the cost of capital, right? So again, simple chapter, but you should be able to explain these, understand these concepts in the right context, and then apply this in the examination. Next, you have market value and enterprise value. These are terminologies. You already know what is enterprise value. It's a very simple concept. It's market capitalization plus debt minus cash. And then, so for example, it should be cash and investments, right? So what happens in case of companies which has investments, right? So if it's a non-earning investment, it should be included or it should be adjusted with cash, right? So market value of market capitalization plus debt minus cash minus investment. That's how it should be taken. So this is your module number 5 or chapter number 5, right? As you see, there are so the content of the textbook is fairly well designed, right? Covers a lot of case studies, questions, etc., right? Which can be comprehensive. I don't see why you would need any additional outside help. Next is the next chapter is laws and compliance in business valuation. So here, like I said, so there's a lot of regulatory requirements for which the valuation is done now. So this chapter briefly tells you about some of those regulatory requirements. For example, what is the requirement of valuation under the Insolvency and Bankruptcy Code? Now, this is a landmark regulation. It has changed the banking industry. It has improved the ease of doing business. It gives a lot of, it allows business owners to leave the business with sufficient dignity. And it also, of course, every regulation will have challenges, but it has done a very good job, right? It has uncovered lakhs of crores of money for the bankers. So what is the application of valuation under IBC? Then what are the relevant section of the Companies Act which requires valuation to be done, right? What is the features of the company's registered valuer and valuation rules? So you should be aware that there's a separate rules for valuation. Then there's SURFACE and there is valuation standards as well. So you should be aware that whatever valuation the normally the valuers do, they are normally guided under different types of valuation standards. One of which is the International Valuation Standards, which is issued by International Valuation Standards Council. And this valuation standard tends to get updated almost every year or every 2 years, right? So that's what we do in this part, right? So and we've given you a brief overview of how the IBC works, right? Which I understand you must have done in the other part of the program as well. So it's going to be a refresher. And as you can see, I'm sure some of you would be smiling that, hey, this chapter contains refreshers of a lot of other chapters. That means the owned content of the chapter is fairly less. So I think it's going to be a scoring paper for you, right? And not very difficult also, I must say. Okay, so this chapter talks about different sections. So there's section 247, there's section 62, there's section 42, there's 192 and so on. So the different sections under which it is done. Then like I said, the salient features of companies registered valuer and valuation rules. So you read about that. It talks about what is the eligibility of a registered valuer as it stands today. What are the qualifications and experience of different classes of registered valuers, that's mentioned here, right? It talks about what are the conditions for registration, what is the, how should be the conduct, how the valuation should be conducted, what should be the contents of the valuation report, and so on, right? Same for SURFACE, another act which helps in recovering money for the lenders. And SURFACE Act, I understand, is also covered as part of your law paper, I hope, right? So we move further. Valuation standards. So again, mostly it's going to be theory. There's no practical part of the valuation standards that you can think of, but it talks about the scope of work, who's the valuer. It talks about investigations and compliance. What investigation should a valuer do, right? And what kind of compliances should they follow while doing the valuation? It talks about reporting. So minimum, these are the things that must be presented in the valuation report. You can expect questions on this, right? What are the different bases of value? Right? We've talked about premises of value as a different part of the chapter. These are different bases of value which is given by the International Valuation Standards, and you see some of these are repetitive. So it's highest and best use, it's liquidation value, investment value, equitable value. We've covered these earlier as well. They come back here, right? Then it talks about it talks about different what are the different approaches, right? When do you apply them? So as you can see, these are fairly straightforward. Now this is an important part. Rule 11 UA. This comes from the income tax regulation. So Rule 11 UA also talks about a fair market value, and you should be familiar with this. You can get practical questions on this, and those practical questions it's easy, but it can be tricky sometimes, right? Then you see that there are brief snippets of what's covered under the Ind AS. I'm sure you are studying Ind AS as part of your new curriculum, and Ind AS 113 talks about fair value measurement. And this chapter or this part of the chapter talks about how do you do fair value measurement. It's a brief summary of Ind AS 113. Right, it says that the valuation should be done from the perspective of a market participant. It defines the fair value, and you must be aware of the definition of fair value. It's a must question. I mean, you can imagine this is something that you are very likely going to get. I mean, I'm of course I don't know what you're going to get in the exam, but I can tell you that these are very important things to consider, right? Then it talks about level 1, level 2, level 3 inputs. Again, very important part of the entire of the subject, right? That Ind AS 113 talks about the levels of input. Now, what is this? When we do the valuation, you need to have the inputs, right? Those inputs leads to the output, which is the final value. So what is the quality of this input, right? Is it all subjective, all considered at the whims and fancies of the valuer, or is it something which is very observable, right? So this standard prescribes the usage of maximize the use of observable inputs, which is the level 1 input, and minimize the use of unobservable inputs, meaning subjective inputs, which is level 3 inputs. Okay. So, and then there are certain examples of this which you can find very useful. Okay. Okay. Now, when we move to the next part, which is the next chapter talks about business valuation methods and approaches. Now, we've already covered what are the approaches in very brief in the earlier chapter. This is where we deep dive into it. Okay, so we talk about the details of the valuation methods. And of course, this is the core part of the entire program or the core part of the entire subject where you would know what are the methods. So for example, you will deep dive into what is a discounted cash flow method, how to calculate the discount rate, right? The nuances of it, the examples of it, the numbers around it, right? You will know about the free cash flow, the concept of free cash flow, how the dividend discount model, which you might have studied in your different paper, strategic financial management maybe, right? How does that tie back into the valuation part, right? So how does dividend discount model connect with the discounted cash flow model? Is the DDM model and DCF model the same thing? Essentially, they are the same things. It's just that it's an extension of the DCF model is an extension of the DDM model, or you can say that the DDM model is the summarized version of the DCF model, right? You will understand this when you are reading this chapter, right? And again, it's very important. You would need to understand the different versions of the DDM model, the single stage, two stage, H model. We've not covered three stage, I guess, here, right? Then you move to the discounted cash flow. Extremely important is the free cash flow for the firm and the free cash flow for equity. What are these? How to calculate these, right? Be rest assured that once you become a CMA, when you're going in for interviews, you will be asked questions on what is the free cash flow, what's the difference between free cash flow to the firm and free cash flow to equity, how to calculate these, right? All of these are going to be extremely crucial and important. What's the difference between net profit and FCFF? What's the difference between EBITDA and FCFF and so on, right? You would need to have those ideas cleared. Okay. So we have multiple examples here. In fact, you should be able to calculate free cash flow from EBITDA. You should be able to calculate free cash flow from net profit. So how do you go about it, right? Two very important parts of free cash flows is working capital investment and capital expenditure. So what are these? How to calculate these? All these questions are going to be important, right? If you have specific questions, I'll be happy to address them as we go along. Quickly checking once again if there's any question, if there's any query that you have, I'll be happy to address it. Okay, seems like there isn't any. Okay. Moving on, right? So from the income statement or from the income approach, we move into relative valuation multiples, right? In fact, relative valuation can be applied in case of terminal value as well. So you would also need to understand what is a terminal value. Now, in your capital budgeting or your NPV methods, you've normally taken care of valuation where you've got the forecast for next 4, 5, 6 years. You've discounted to get the current value, right? Now, in this part, 7.1, that is, you would need to assess how to get to those forecasts. One, that is calculate the free cash flow. Second, you will also have to look at the terminal value, which is the infinite value, considering that the business operates as a going concern, right? There is going to be an indefinite or an infinite life of the entity. So how do you value that part of the cash flows of the entity, right? That is where you will also find the bridge between DDM and DCF. Next, we move into the multiples based valuation. So you have the earnings multiples, like we discussed about What is enterprise value? What is price to earnings multiple? What is price to book value multiple? How do you assess them? Right? All of that is covered here. So if you see here, we are taking first the market price method, where you would value an entity based on its listed price. That is the price that is available for the asset that is traded in an active market, right? So you will have to identify these keywords traded in the active market. So we've taken that here. Next, comparable companies, right? So if you're valuing a company which is a very large IT company, but it is not listed on the stock market. So can you use Infosys and Wipro and TCS as benchmarks to value this private large IT company, right? So you would use the PE multiple, you would use the price to book value multiple, or you can use the EV to EBITDA multiple to value them. Now, even while using the price earnings multiple, right, there are variations of it. So there's trailing PE multiple and forward PE multiple. You should understand what are these, how to interpret these, and so on. Then you have the book value multiples. Again, when can you apply the book value multiple? It should be applicable in case of asset heavy companies, right? Then you have the price to sales multiple, which can be applied in case of startups or companies which are mostly professional services firms and things like that. Okay. Next, you have the price to cash flow and enterprise value to EBITDA multiples, right? Again, enterprise value to EBITDA is a very, very important ratio. A lot of analysts and valuers are applying this multiple now, right? And on one hand, it can be fairly simple, but then you can get questions which can make the questions a little tricky for you. So I would request you to take a good care of this. It's a small part, but then you should be able to have a good grip on the concepts of enterprise value, how to calculate it, the variations of it, and so on. Then you have comparable transactions, right? So there you can have sector specific multiples. For example, if you have to value, let's say, a company like Flipkart, which is a large e-commerce company, can you compare it against, let's say, an Amazon? Or if you have to value a large chat based company, can you use the valuation as compared to WhatsApp? So here's an example there, right? You could use the example to calculate the value. Okay. Then you have book value multiples. We've talked about price to book value, right? So those are also covered here. And then moving on to revenue and sector specific multiples. So all these are. So like I said, this module is all practical, and you would have to have good concept. And this is probably the only module which will give you a good grip on the subject, and you will be able to apply this both in the exam as well as a professional once you qualify. So as you can see, there's a lot of questions here, a lot of case studies are given, a lot of practical examples are given. As long as you are able to solve these, work on these well, you should be good. Now the 8th module is covering different types of assets and liabilities, specific assets and liabilities. Here you would apply the concepts in that you've learned in module 7 into specific cases, right? So like plant and machinery, investments, inventory, intangibles, human resources, real estate, EVA, right, and liabilities. So for example, plant and machinery, so there are some small examples out here, right? You could use this, and as you can see, it's a small part. So some conceptual understanding with very nominal set of calculations will help you sail this through, right? Inventory, again, you already know that there are accounting regulations which tells you how to value inventory. It can be at cost or net realizable value, whichever is lower. So mostly this part deals with the costing of the inventory, right? So this is more of an accounting chapter rather than a valuation chapter. What cost should be included and what should be excluded from the inventory. Valuation of investments. If you already know the valuation of companies, You know that valuation of investment is going to be fairly easy. It is just a refresher from the previous modules. This is going to be an important part, which is valuation of bonds, because this is specific, right? And there are some terminologies that you will have to understand very well, right? About bond yields and redemption premium and call option and put option and so on, right? So those parts have to be understood very well. So once again, the bond valuation will apply the same principle. That is, the value of the bond is going to be the present value of the cash flows. These present value can come in two parts, or the cash flows can come in two parts. One is the interest income that you will get, and the second is the terminal value, which is the redemption amount that you will get. So you take the present value of both of these, you will get the value of the bond. Okay. Now along the way, you would need to calculate what is current yield, what is yield to maturity. So the discount rate that we use in case of equity or in case of business is the yield to maturity in case of bonds, to put it simply, right? What is the internal rate of return for the bond? So YTM is the same as IRR and can be calculated by applying the concept of interpolation. And we've also told you that if in real life you have to do it, if in practical life you have to do it, you can simply use the rate function in Excel or the IRR function to calculate the YT. Okay. Then there are some additional concepts like duration, which also has to be understood, and you can expect questions from these parts as well, right? What is modified duration? What is Macaulay's duration, and how that impacts? What is the impact of interest rate on the bond value? What is the impact of term to maturity on the bond value, and so on? So those are some of the things that has to be understood well. Now moving on, right? So you will have a small introduction to warrants. What are these and how it is valued, right? So warrants are very similar to, I mean, it's a quasi equity, right? It allows, or it gives the right to a warrant holder to buy the shares of the company, right? And then you move into the preference shares, which is very similar to equity. Very interesting is going to be valuation of intangibles, where you will take copyrights and goodwill and brand. Now they all might sound similar, but they're very, very different, right? Many people confuse between valuation of goodwill and brand. You understand this very well from this chapter, right? It's covered very well here. Now, when we value intangibles, there are some additional methods which are applied, which is the relief from royalty method, premium profit method, distributor method, excess earning method. Those are covered here in brief, and then there are some brief examples. So we have not deep dive into it. We've kept it at surface level. We have not given too much details, right? For example, relief from royalty method can be fairly complicated to apply. There's no practical question on that, right? We are only covering the theoretical questions, right? As far as I can see right now. Now copyrights, again, there's a small example here. Interestingly, it says V Goyal. Goodwill, again, so you should know that goodwill is calculated only in case of a merger or an acquisition. If a company is acquiring another company, the value that this company pays to acquire the other company. So let's say company A is acquiring company B, right? Now, company is going to pay the consideration to acquire company B. Now, what is the value of B? Let's say the value of B is 200, but the B shareholders are not willing to sell the company for 200. So therefore, A ends up paying 250 to acquire company B. So the value of company B is 200, but A is paying 250 to acquire B, right? So goodwill is the purchase consideration, which is 250, minus the fair value of the assets acquired, which is 200. So therefore 50 will appear as goodwill in the books of A, because it has acquired company B at a premium. So this premium that is being paid is normally known as goodwill, right? You should be very clear about it. Then we've given you a small note here that goodwill is not tax deductible anymore, right? But however, what happens in case of an entity which is not a private company or a public company? In that case, there are some additional methods of valuing goodwill, which is covered in other parts or in other courses as well. So that is what we are capturing in this example, right? Then we do have an example of brand valuation using relief from royalty method, but it's a simple example, right? So relief from royalty method says that, hey, if I have a brand and but then it is internally generated brand, right? So I cannot record my brand in my books because that's the accounting regulations don't allow me to do that. So if you acquire my brand, how are you going to value it, right? So you will say that, okay, if you're using my brand, meaning what is a brand value? So we are saying that instead of not owning the brand myself, if you had owned it and I was paying you a royalty for using your brand, what is the saving that I'm having in terms of royalty payments, right? How much royalty am I saving by having my own brand instead of using your brand, right? That is what the relief from royalty approach is. Very interesting approach, not very complicated, but requires good understanding of the business and the numbers, right? Once you have that, you can easily calculate this. So that's what we have in terms of intangibles. Then you have valuation of human resources. There are some illustrations out there, right? Now, of course, human resources are not recorded in the books of accounts, but you will see that now in today's times, there are teams which are getting sold, or there are businesses which are getting sold, but those businesses primarily consist of only people, right? It does not consist of anything else because the offices are leased, the laptops are leased, right? So there is very less number of tangible assets. So if I have to acquire another business, that business primarily consists of the team members who are qualified, experienced individuals. So I'm saying that, hey, I will buy your team. I have my own clients, but I don't have the capability to execute that. Therefore, I am acquiring your team, right? So there, how would you value that human resources? That's number one. That's one example. The second example is very interesting is under the Companies Act, you might have heard of the concept of sweat equity. What is sweat equity? If I am the founder of a company and I have been doing this business, but because I'm the founder and the business could not afford my salary in the initial years, I did not take any salary. But now, once the business has done well, I don't want to withdraw salary, but am I not entitled to some compensation? So my compensation could come in the form of shares that the company can give to me for free. Now, this is not free, right? This is money which I'm not paying any cash to get the shares, but the company is giving me the shares in exchange of the work that I have done for the company, the sweat that I have lost for the company, right? So Companies Act says that if you have to give the sweat equity shares, you have to value the amount of service, the value of the service of these individuals, right? How can you value the service of the individuals? So that is where you would do the valuation of human resources. So two very important applications in real life. One, when you are issuing sweat equity shares, and second, when there are transfer of teams or transfer of individuals or transfer of businesses which primarily consist of human resources. That's how you can calculate the human resource, right? So these are very small examples here. Of course, these are simplified examples, but it should be useful to you. The next we move on to is the valuation of real estate, right? Now, if you go by the regulations, real estate valuation is primarily done by land and building valuers. That's a separate asset class completely. Technically, you have to be a civil engineer to be able to become a registered valuer for land and building. But ICMAI has a lot of professionals who do tangible asset valuations, right? And therefore, ICMAI also can have land and building valuers as part of ICMAI RVO. Right? So you've got a flavor of real estate valuation here. What is the value of property? It is the replacement cost of construction minus allowance for depreciation plus value based on property features. So that's one context of valuation, right? Some simple examples, right? You can use the market approach, you can use the income approach, you can use the cost approach and calculate the value of properties. Next, you have value added, very important part. In fact, I was going through your model question papers and I could see the question on economic value added as well there, right? If you look at the model question paper, it has questions on EVA, MVA, and I'm sure that you can expect questions on EVA, MVA, economic value added and market value added. What is economic value added? It's a very interesting concept, right? It was formalized by Stern, Stewart and Company. Economic value added is the financial performance measure that comes closer to any other capturing it captures the true economic profit of an enterprise. Look at what it is saying. It is saying economic value added is net operating profit after tax minus the currency cost of capital. So in any particular year, what is the economic value that the business has added? What does that mean? So it says, see, let's look at the cost. Let's look at this equation and we'll go from the right. OK, so what's the cost of capital? It's saying that if the company has got equity, the company has got debt. So equity is provided by equity shareholders, debt is provided by lenders. So if you've borrowed money from the lenders, you have to pay them some interest. One, if you've taken money from the founders or from the shareholders, you have to generate some return for them. Correct? So let's say the lenders are expecting 10% return, the equity shareholders are expecting 15% return. So 10% into how much amount of money that you've borrowed plus 15% into the total value of equity. That will give you the currency cost of capital, isn't it? What is the capital employed into cost of capital? So you'll have to break it down. OK, capital employed would be broken into debt and equity. Cost of capital would be broken into debt and equity. So you get the currency cost of capital. So you're saying that this year, this is the amount of money that you should have generated. Right? So let's say this amount comes to about 200. But your net operating profit after tax is 250. So you're saying that your economic value added this year is 250 minus 200, that is 50. Right? Very interesting concept, very, very widely used in business, right? Has a huge practical application, is considered by various professionals and businesses. You would find even companies, listed companies, reporting their economic value added in their annual reports. So you should definitely understand this very well. You've got the detailed calculation of this. What should you consider in capital employed? What you should consider in your net operating profit after taxes? All of that is given here. Read this carefully, practice this carefully, right? Prepare this well for your exams as well as your practical life. OK. Last is valuation of liabilities. Here it's fairly simple. Most of your liabilities are recorded at the book values, right? You should also understand some things around contingent liability, for example, something which is an off-balance sheet liability should be covered here. Valuation of liabilities has become important after the advent of Ind AS, right? That's very, very important. You should understand. For example, let's say a parent company has given a guarantee against a subsidiary company for a subsidiary company. So subsidiary company has taken a loan, right? And the parent company has given the guarantee because subsidiary did not have sufficient assets. So now when you give a guarantee earlier, it was never recorded in the books of accounts. Now it says that you need to have the impact analysis of that, right? If the subsidiary is doing well and the guarantee will not be invoked, no problem, disclose that. But if it is not doing well and the guarantee may have to be invoked, then it's a potential liability for you. So therefore the parent company has to assess it and record it. Right? So those kind of concepts have come in as we improve on the accounting landscape. So you should be understanding that well. Then you also have something called contingent claim valuation, theoretical concepts to be introduced here, right? So mostly this part you would expect mostly theoretical questions, but EVA, MVA, definitely you can expect a lot of practicals, right? So that's what we have as part of your module. I've given you an overview of this, right? I hope you've understood this. Again, having done the walkthrough of the entire valuation syllabus, right? Oh, I missed out on this, right? So the next you have is valuation in mergers and acquisitions, which is complicated. So mergers and acquisitions, of course, you know what is merger. So there are different. So you've heard of one company acquiring another company, one company merging with another company, one company demerging one of its business undertakings to another company. Right? All of those concepts are here, right? We've given some examples of some interesting acquisitions and mergers that has happened. So you can expect some theoretical questions around the concepts. What is horizontal merger? What is vertical merger? What is forward integration? What is backward integration, etc. Right? Now this part is called acquisition pricing, right? So and this should be goodwill actually, right? This word is cut off apparently. So you need to understand the various things in this chapter, right? You need to understand what is the value of the target that you are going to acquire. That may be one set of questions. Second, what is the value created for the acquirer, right? Once the acquisition has happened, what is the value that is created? You also need to understand the acquisition premium, right? What is the premium that you have paid for the acquisition? So this is very similar to again goodwill. So you are saying that what is the deal price minus the pre-merger price. So pre-merger price was considering the fair value of the target. So what is the goodwill percentage, also known as the acquisition premium percentage, right? That's what's given here. The next part is value of the target to the acquirer. So again, you talk about what is the gain. So for this, you need to understand the premium, you need to understand the synergies, right? So if, like I said, if in my previous example, we were talking about let me see if I can write here. No, I can't. Okay, so in my previous example, I was saying that the value of the acquisition, value of the company that I'm acquiring is 200 and I'm paying 250. So I know 50 is the premium, but out of this 50, how much of synergies can I expect, right? So if I've paid 50 extra after acquiring, I would be getting cost benefits, I would be getting revenue enhancements and so on. So we call that synergy. So let's say I'm going to create value, create additional value of 70. But I've paid a premium of only 50. So my acquirer's gain is going to be 20 again, right? So you should be able to assess that. You can expect questions around that. So a lot of small questions, and I can tell you that this is one part of the entire course where you would have risks of getting confused, right? I can say that from my experience as a student. If you're not thorough with the concept, then you can definitely get confused in this, right? So you would see applications of all the other concepts that we've done in the past. It's going to have application of goodwill. We just discussed that. How would you value the target? What's the impact of the acquisition on the EPS, right? Should you go for this acquisition or not based on certain assumptions? So all of that is covered here, right? Everything that we've covered in the past can be captured here. Right. Another part is post transactions, incorporating the effect of intended synergies. Right. You can expect that. Antitrust and security issues, some small questions around it. Right. The acquisition sometimes may not be approved by the regulators because of competition or because of monopolies that the acquisition might create. Right. So you will get a flavor of that. How would you value control? Right. So once I have, so let's say. When I'm acquiring another company, I don't have to acquire 100% of that company, right? It's possible that I'm acquiring only 20% of the other company, but by acquiring 20%, I will get the majority shareholding because everyone else is a minority shareholder. So here, by acquiring 20%, I will also get control, right? For which I might have to pay a premium. So that's what is covered under valuation of control, right? You should be able to understand that. So by and large, that's what's there. Then you have financial modeling, right? We've briefly spoken about it, that how can you create forecasts of the, how can you create forecast of the companies, right? So based on historical data, based on companies' plans, based on some of the financial statement analysis that you might have done, right? You can forecast the future performance or the future financials of the company, right? So some simple applications like common size, etc. But then how can you forecast the financials? So that is also covered here, and I'm very happy that this is covered as part of the syllabus, because the students will find some very advanced concepts which are very simplified for you in this module, right? So that's there. Once again, checking if you have any questions at all. Right, that's about it. So that's what's covered in your syllabus. Any question? Again, I'm going to take another 5-7 minutes max, move through the model question paper, and then again we'll wrap it up. Okay, so if you look at the model question paper, now of course this question paper is a sample, and it consists of both strategic performance management and business valuation, right? So the first section as per the new syllabus is section A compulsory, but it is 30 marks now, and I understand earlier it was 20 marks. So for example, you have the first question which is coming from strategic performance management. The second question, net profit margin, comes from strategic performance management, also from financial statement analysis. It's covered in both. Balance scorecard, strategic financial management. Cost function of the firm is given by this. At what level of output? Average. Okay, strategic performance management, strategic performance management, strategic performance management. This one is coming from business valuation, right? So of course the question is going to be evenly spread. But again, so for example, the free cash flow of the firm, right? Simple question, 2 marks, easy, quickly calculate, just one line solution, and you'll get to the answer of it. Okay, same. See again, cost of equity based on CAPM, RF plus RM minus RF into beta, right? Easy, one line solution, one line answer, one word answer, quick 2 marks. You can get it here. If a company has a P ratio of 12 and market to book value ratio of 2.0, the return on equity would be, again, simple mathematical questions, and you would be okay, right? So you want to bring the current ratio below 1.25. So all these are very simple questions, right? SURFACE, asset restructuring companies, where do you find them? Banking regulations, SURFACE, SEBI, Companies Act goes under SURFACE, which is the following is not the core principle of valuation, right? Calculating calculating the current yield. So all simple questions, right? Quick questions and very scoring, I must tell you. And if you see, there's a good proportion of practical numerical questions in this part, right? Section B again is you have to answer any 5 questions out of 7 questions. Each question is 14 marks, and as I can see and as you can see, most questions are broken into 2 parts, so 7 marks each, right? One good thing that has been done is that it's all the same. So part A and part B is coming from the same section in most cases, right? So question number 5 is coming in from valuation. You have the valuation of warrants in this case. The second one is valuation of equity, the potential value to be placed on XYZ, coming in from mergers and acquisitions under valuation. Okay. The question number 6A is talking about brand value. Again, simple, small question. A little bit of trick here is giving you information about inflation for 2020 and 2021, right? You might be tempted to use it, may or may not be useful. But again, it gives you profit before interest and tax, gives you 2 line items which has to be adjusted because it should be all operating profits, right? So you adjust these figures with your profit before interest and tax. You have the tax rate and you have the capitalization factor. Quickly you will get to the answer. Like I said earlier, The next question is asking you to compute economic value added. It gives you the P&L statement, right? You know what adjustments you have to make here. It gives you the balance sheet. So you know from the balance sheet you can calculate the currency cost of capital. And you get to the value of EVA. Next you have question 7A is a hardcore mergers and acquisitions question. Once you've read this chapter, right, you know that these are common questions that you get in mergers and acquisitions, simplified questions from an M&A context, right, and you can easily get to the 7 marks. Now the next question is considering the takeover. So again, it's a takeover question. Once again, question coming in from M&A. You can expect a lot of questions from M&A, like I said, right? And it is asking you to evaluate, will the shareholders be better off or worse off with this acquisition, right? Or are the shareholders better off than they were before the merger? So you have these scenarios which are given to you based on which you evaluate the viability of a merger. Common evaluation done under M&A chapter. Okay. Question number 8 is common size statement of Mars Limited, and you have the interpretation. This is a class 12 question, right? You know that in case of common size, you take everything on the balance sheet as a percentage of total assets. So all you have to do is just some calculator punching, right? Nothing else. 696.6 divided by 58,676.64. 30.07 divided by 58,676.64. 31,256.89 divided by 58,676.64. Into 100 in each case, right? And you've got the common size statement. It's a laborious question, but it's a very easy question. I would do this as the first question in my section B. ABC Limited run and managed by an efficient team that insists on investing 60% of its earnings in projects that provide an ROE of 10%. Despite the fact that the firm's capitalization rate is 15%, the firm's current year earnings is 10. At what price the stock of ABC Limited sell, right? What is the price? So you simple security analysis question. Calculate the present value of growth opportunities. Justify why would such a firm be a takeover target. So this is a very interesting question, right? A small mini case study kind of a question. You calculate the price and you say the present value of the growth opportunities and say why can it be a takeover target. So when you say present value of the growth opportunities, you're calculating the intrinsic value, comparing it against the price, and then you say it can be a takeover target or not. Okay, so that's the question for you, right? Like I said, good concepts, good coverage, lot of practical aspects covered in the entire subject. Question paper is balanced between short questions, long questions, theory questions, practical questions, judgment related questions, mechanical questions. That very good balance, and I think this is going to be good, right? So any questions? I am done with whatever I had to explain. If there are no questions from the participants, we can call it a day. Okay, any questions at all? No?